Pop in. All right. Good morning. Welcome to the weekly meeting. 420 for all you dope smokers. April 20th for the rest of us. We're going to talk about bias and structure. I think these are two important themes that some people I know they don't understand it, but I think if you're going to follow your trading plan or come up with a plan, it needs to be based around something, right? If you're just trading structure, that's fine. Um, Maybe you're just trading zones. I'm trading from zone to zone. That's fine. But something has to trigger the trade idea. And in my case, um, I come to the market with a bias based off of an order block, right? So I have an understanding of which which direction I need to see the market go. And this is the thing. Um, some people feel like I just get in the trade because I think the market is going that direction. And that's not true either. So I want to kind of break this down and go step by step. And this is just how I trade. And after I do this, I would like for Kim to do the same. I know I didn't talk to you about it, Kim, but OG or whoever has a different style. But if you can articulate your style, I think people will understand. Okay, there's a set approach that I take for doing this, right? So that way, when you approach the market, you're not just approaching the market wondering what's going to happen. I come specifically looking for something to happen, and I'm going to show you, and I'm going to give you a demonstration of what I'm talking about. Again, this is not the my way is not the only way of doing it. It's just a way that I've discovered that works for me. All righty, I'm going to take Euro USD. Um, I don't normally trade Euro USD, but that's beside the point. Okay. Um, on this bigger picture, you see that the Euro USD has been falling for a while, right? This is 2014. It falls, it consolidates, it falls again, right? At 2021, it fell. This pullback is just a retest of this level. Of course, it's a super high time frame, but none of that matters. This is just how the market. This is a 1 hour chart, and it looked the same way. I mean, everything is the same. So it pulls back, and it's consolidating, right? In my opinion, it's turning around, right? The market is getting ready to sell again, but it pulls back. It goes into this Wyckoff, right? If you look up Wyckoff uh, accumulation and Wyckoff distribution, this would be a distribution pattern, right? Um, if I zoom in here a little bit closer, none of this structure actually matters to me until I get this down move right here, because this down move breaks this low. Then it pulls back to let me in the trade, and now it pushes down to my area of interest, which is this green box. I trade based on a concept where we get a displacement, a push down as a displacement. We trade back into an imbalance, and then we take the trade to go south. You can take this trade to equal lows. Because I'm looking at structure, I know that there's an imbalance there. I want to take the trade all the way to the imbalance. If I fib from here, this is confluence. If I fib this up move, if I get my fib, Okay, so if I take my fib and fib the up move, look where this imbalance falls, right at my 62, in between my 62 and the 78. So if the market was pushing up, this is a good pullback to expect it to keep pushing up. So if you're biased and you're saying, hey, Todd, this is a push up and this is going to keep going up, this is still a tradable trade because it's going to pull back. It'll bounce here. And the next level you should look for at the push is around your 60, your 618 or negative 27. If you're bearish, then this push down will eventually hit this imbalance. It'll pull back and it'll keep going further. Either way, on either side of your bias, we have about 468 pips or so available for us. So it's tradable, in my opinion, either way. Now, the latest thing that happened in the market in the last 2 weeks is it pushed down with this move right here. This is a displacement candle for me. So what I need to be able to do is, let me just trash everything. That's the easiest way. What I need to be able to do is fib this candle. I'm going to fib it the direction that the market went. I'm going to mark my zone because I expect a pullback to my golden zone to discount or to premium. This is going to pull back to premium. Right now, prices at a discount. It's low. I need to pull back higher. I mark my 78 with the line. I can delete my fib. If I drop down to the 4-hour, there's a high probability that in my zone, my golden zone, there's an imbalance. This imbalance, the 78, there's a high probability that when you have a displacement candle, you're going to see these imbalances. So for me, this is my target. This is my target. Okay. So I think at this point, if I'm trading this down, I think this is how I would view this structure. So for me, when price comes down, this was a move, this was a pullback. This was a move, this was a pullback. Then it moved here, then it pushed up. This push up right here broke this high. Let me remove everything. This push up broke this high for me. That would qualify this move. This is the chalk. Change of character. This is the move that let me know that price is ready to go higher. Now I got faked out on a smaller time frame, on the smaller time frame chalk, but that's fine. We're going to lose some trades, but the point is now it's for me, this is a tradable event. This chalk. What do I want to see after the chalk? I want to see the market pull back to give me an entry. So if I fibbed my chalk move, my impulse move up, this pullback banged right here at my 78. It probably went to the 88. It went past the 78 to the 88. Now it pushed up. So right now, price is in between two levels, this high and this low. Some of you still need to see which one of them it breaks, and that's okay. But for my model, the way I trade, based on the higher time frame structure, the 2-week chart that had the 2-week order block, I expect price to trade back into that 2-week order block. This was my zone. I marked up on the higher time frame. This was my 78. Based on that, and the chalk, I have a tradable situation here. So when the market opens, what I would like to see is this pull back down a little bit further to give me a better entry. But after that 1 hour candle, I can get in the dang gum trade. Because for me, everything that I need to see has transpired on the chart. The only thing that I can do now is look for an entry, right? So it's either going to push down, which would be great, or it's going to push up and then pull back. So if it pushes down, I can enter the market after the 1 hour candle. If it pushes up, then I'm going to have to wait for it to pull back and get in. Does everybody understand that? Is anybody lost? So for me, if it goes back to the 62, which I assume it will, I think it's going to come back up here because that's a huge imbalance. But at least to the 62, that's 119 pips. If it's a little bit higher than that, we go, it's more pips available. All right, can I explain the order blocks and how to use them? Okay, the hedge trades. Hey, Joseph, we need to do a one-on-one for hedge. Hedging is I'll explain this briefly, but hedging is a more advanced technique because you have to use both sides of your brain. And most people, when they start trading, they can only use one side of their brain. They only want to trade the move. And this is what I mean. The move on this trade is actually the down move. So if someone was trading Euro USD, they might have got in this trade up here and they caught this whole move. So if you follow me on this, this is a 200 and let's just call it 250 to make it round numbers. They caught 250 pips on this sell trade. Maybe they believe the market is going to continue like I do. I believe the market is going to continue down. So maybe you don't want to close out your 250 pip trade, but you also want to add to you want to get paid on these pips twice because the market is going to pull back. The market goes down, it's going to pull back, and it's going to go further down. So you don't want to get out of this move, but you want to add by catching this move, and then you can sell again. You can add another entry and catch more pips this way. A hedge is you caught this move, you're in this sell. Now you can add the same lot size for this buy. That way you're not losing any money. Then once it starts moving down, you take profit on this move that was up and you add another sell position for the way down. That's a basic explanation of how you can hedge. But you really kind of we can go down a rabbit hole with the hedging. Now, as far as order blocks, an order block is when you have this green candle and then this red candle that engulfs it, that's a bearish order block. It means the red candle is longer than the green candle. Green candle, red candle is longer, bearish order block. The significance of this is telling us that the market is going lower, right? If it was the opposite way around, if it was a red candle with the green candle that's longer, that signifies to us that the market is going higher. Red candle with the green candle, market is going higher. In this particular scenario, when the market got to this resistance level on a higher time frame, this right here is a bearish order block on the monthly. So the market pushed back up into this bearish order block and it fell. So what I would suggest to you is go to YouTube and just type in order blocks Forex. There are like 5-minute videos, 7-minute videos that don't take a lot of your time. There are longer videos if you want to watch them, but you can get better explanations of what order blocks are and how we use them. In a nutshell, an order block is basically what we're saying is banks or big institutions. This is a signature that they are entering the market, right? Because the market is going up, and then some big institution had to fill enough orders in order to create this red candle that outweighed this green candle. The market was going up. Some institution flooded the market with sell orders and pushed the price down. This is the signature that the big players are in the market, and we want to go the same direction as those big players. So if we wait to enter the market until we see that signature, then we have a higher probability of being successful. So after you get this order block, ideally you want to see price pull back, right? You want to see the pullback. For me, it's everything, right? And this is a scenario that if it doesn't do exactly what you want it to do, do not enter the trade. This is what will make you extremely successful. If you are a person that doesn't take the trade unless it does exactly what you want it to do, you're going to make money. You're going to make serious money, and you're going to lose a lot less. You will take a lot less trades, but you will lose a lot less. So we talked about what the market has already done. I'm looking forward to what the market will do. And I want to enter this trade to buy it up. Then I want to turn around and sell it once it gets to my zone and shows me that it wants to sell. But I can't buy it up unless I see this change of character. When the market went up and broke this high and pulled back, it told me, hey, it's time to buy. It's time to buy this pair, and it's going to buy up. Where is it buying? It's buying to our zone. If you look in this zone, if you study liquidity, the first thing you notice is these relative equal highs right here, the wick of this candle and the wick of this candle. It's not perfect, nor does it have to be. It's relative. That's in your zone. This is a target because there's liquidity up here. What is liquidity? There are resting orders. There are buy stops, and there are stop losses for people who took shorts. So the market is going to draw on this liquidity. It's going to run through it. It's going to liquidate the people who don't see this coming. So this should be your first target. Then you know that since these were one-way orders, these are only sell orders. It sold so quickly that the buyers didn't get a chance to get into the market. That's why the green candles need to run up and mitigate the imbalance. So if you are struggling with the idea of what an imbalance is, right? You see the wick of this candle? It needs to meet the wick of this candle. Oh, wait, this candle doesn't have a wick. So this green wick should have came all the way up here to meet this candle. It didn't happen. So sometime in the future, this push needs to come all the way up here, right, to mitigate the imbalance. At least 50% of this imbalance. We call that consequent encroachment. These concepts will be talked about on YouTube if you need more instruction, or you can hit me up one-on-one and we can go over that. But I don't want to insult anyone's intelligence. It's just if you understand these concepts, then you come to the market with an understanding and an expectation of what you need to see to validate your trade or invalidate your trade. And for me, it's this simple. Once I got the chalk and the pullback, I can get in the trade because Now I expect for price to give me the up move somewhere in this zone. It can turn around. It can turn around right when it hits this zone. It can push up a little bit further and turn around. This right here, this down move right here that creates this bottom right here, we call this a breaker block. So price could push right up to this breaker block area and turn around right here. All of these things are valid, and they are a possibility. So as a trader, I'm watching and I'm aware. Maybe I don't watch this 24/7, but maybe I go up here and I put an alarm, add an alert, and it comes to my phone. Check on your trade, right? And now when price hits here, I know to look at my phone and I say, oh man, price is close to the area where it might turn around. So I need to either TP, take profit. Maybe I took 90% off my trade. Maybe I just have a runner, but I need to make sure that when it turns around, that I close my buy position, but more importantly, I can enter my sell position, which I expect to go down a lot further. And I have my buy position. And that's my approach. That's what I'm looking to get out of this trade based on that 2-week order block. That 2-week order block, whenever I see this imbalance, y'all already know, like that's a go for me. I look for price to trade back into the imbalance, and I look for price to sell. ICT mentorship 2022, slide 3. Do I have any questions? Well, I think my trade setups are masterful and they're great. Kim trades her own style. OG trades his own style. So I would love it if one of them would come and explain what they look for and how they find success trading. Do one of y'all want to break it down?
Yeah, let's save the best for last, and I'll go. We'll talk about the dollar.
You want to share your screen, OG?
Yeah, yeah. And this is a beautiful thing because we talk about all this stuff as much as we can. We're very, very privy as far as fundamentals. We're getting better and better and better. So, I love the numbers. But what happened with the dollar was very beautiful because of the price, 104 to 106. Let's see here. I got to move some stuff around. Hold on. Oh, beautiful Judas candle. Yeah. So what we mean by Judas candle, usually the wicks on both ends of the candle will be even. But in this case, it's not necessarily even, but where's the low? Okay, we talk about discount and premium a lot. People are not understanding what it is. Now, I figured it out. I don't know how. I just like to follow stuff, right? But 104 is the discount of 105. 106 is the premium of 105, right? 105 is the point of interest. I'm learning to not mess with the 5, mess with the 4, and mess with the 6. The 5 will get you in trouble, right? So I'll keep repeating it over time, but hopefully people can grab this concept because when I say 104 to 106, on the money, right? Now, if you can understand this with the dollar, you can do that with other pairs. And I'll just jump to GA right quick because it's the same kind of thing. 194, 195, 196. See, you're supposed to be buying from 194 to 196. In this case, it came down to 194, went to 195. It never made it to 196. That means it's a sell because it's supposed to go from 194 all the way to 196, just like a 104 on the dollar to 106. That's what was supposed to happen here, but it never made it. It stopped at 195 on the money. So it goes right back to 194. So it's a discount premium mentality. And as you can see, I don't mark up because I'm only focused on the numbers, right? 194, is that what it is, right? On the money? No, that's 191, 500, right? It went down to the discount. So if it gets below 194, it's telling you it wants to go to 191, then back to 194 to 195. It's a measurement. So at 191, 500, 190, right? That's where it's supposed to be going. It never made it to 190. It made it to the discount of 191.5, 191.50. Back to 192.50, back to 193.50, right? It'll go 150 to 350, 350 back to 150. If it gets below 150, then we're going to 190. Once it gets to 190, it can go to 189, the discount, right? And then it plays in between the ranges all day long. So I'm having a lot of fun with this. And it just dawned on me within the last year. This is my elevation point. This is my aha moment with the numbers. But let's go back to the Dixie, because what's going to happen moving forward? The dollar has to break 104 or 106. If the dollar gets below, just like we said with GA, it got below 194, it went to 191. Same scenario with the dollar. If the dollar gets below 104, it's going to 101. If the dollar gets above 106, it's going to 107.5. And if we remember at the beginning of the year, we headed to 107.5 and came up short. And ever since we came up short at 107.5, we went all the way down. The dollar tanked. So that's what we've experienced. Now the dollar is getting ready to elevate again. So where is it going? Well, if it gets above 106, it's going to 107.5, the same area that we did not touch on the money. So you're waiting for it to go to 107.5. Why is it going to 107.5? Because we're not printing yet. Once we print the money, the dollar's going to tank and the market's going to go parabolic. They're supposed to print that money in June. So the dollar can be bullish until June. But how do we know it's bullish? Once it gets over 106. It's going to break 106, retest 106, and go to 107.5. Or it's going to drop all the way down to 104, break 104, and go to 101. Either way, those are pivot points. If it goes to 101, it's going to bounce. If it goes to 107.5, 108.5, it's going to bounce. We've been waiting for it to go up to that imbalance. 108, 110. We're waiting on that. So it's going to show us what we need to see. So I wanted to bring that up to the people, because we'll notice that just because the dollar's going up don't mean that our pair is going to go down. They can go up at the same time. You got to be very careful about that. So I like to know where the dollar is. I don't use it for trading purposes, but I definitely want to know where it's at all times. So that's pretty much all I got. Any questions? Matter of fact, we could step into Bitcoin right quick, because it's the halving. We're in the halving right now, and we're about to find out. So with Bitcoin, like I said, 65,000 is very pivotal, because if the candles get above 65,000, we're going to 75,000 and 85,000. If the candles get below 60,000, then we're going from 60 to 50 to 40. Those are the ranges. So hopefully people can grab this, because it's a very simple concept. If you think about 4 quarters making $1, right? 25, 50, 75, $1, right? Same thing with Bitcoin. It's 25,000, 50,000, 75,000. We got to 74,500. We didn't touch 75. Now, what is this going to do? Because if it gets above 65, that means it's going to 75. If it gets below 60, it's going to 50. is 60, 50, 40. It's going to decide which range does it want to be in. 60,000 to 65,000 is a transitionary level. It's trying to make a decision if it wants to be over 65 or under 60. If it gets over 65, it's going to 75, 85. If it gets below 60, then it's going 60, 50, 40. That means you should be buying from 40. But just like GA, when it goes from 194 to 195, it was supposed to go to 196. It didn't make it. Gave you your entry at 195. Same situation here. If this gets below 60 and goes to 50 and doesn't make it to 40, then you know it's a buy because you're going to get the reaction at 50,000. So you're not by yourself. That's for one. We got people here who know this. So we will have these conversations. Those are your decision-making points. 60,000, that's a decision-making point. 65,000 is a decision-making point, not 61, not 62, not 63. You gotta see that, right? So we got to keep having the conversations to make sure that people got these numbers in line and understand when you're at discount, you have an optimal trade entry. When you're at the premium, you have an optimal trade entry. Outside of what we do with our fibs and all that, we're just using the price as a pullback zone. And then if you add your technique, when you're at the premium, when you're at the discount, that's when your best analysis should lead you into catching that trade and staying out of the noise, staying out of the confusion. Your entry, it's only here for 5 to 10 minutes. It spends 1,000,000 hours right here. Look at all this time it spends right here. And this is not the best position to take. Yeah, you can get a buy right here. But what if it sells? That's the midpoint. You shouldn't really be making no decisions here. You should be making decisions here and here because it ain't going to be there long. Anytime you get a look at the wicks, I got this wick right here. All I had to do was watch that wick and cover the wick. That's about as textbook as it gets, right? When you're up here in these wicks, look how many opportunities you get on this level right here. If I don't have any of this structure and all I had was this, there's no way I don't catch that because it's wicking, right? It's respecting the liquidity. This bullish candle, why is this so bullish yet it didn't break these wicks? There's no reason why this couldn't just break this right quick, right? Came up short. That's where you're supposed to be entering at. As soon as this doesn't break this wick, the second candle, as soon as that happens, I'm on this candle because it didn't break the wicks. If it don't break the high, it's going to go approach the low. That's the low it was approaching. We don't miss these entries. These are catbird textbook entries. And you're reading the health. And then here's the wicks. Sweep candle, bearish order block. Like Todd says, consuming. As soon as this swept and this consumed, I'm catching one of these candles because you only see that. There's nothing else to see. As soon as you got the bearish order block, that is the most important candle in this pattern, is this candle right here. So everything after that is cake because of this sweep candle. As soon as that was done, it was a wrap. You catch all the pips every time.
Appreciate it. Appreciate it.
And it's an accountability thing. What do you see? If you see it, do something about it. Like, you can be accountable. Like, you have answers, you get the answers, and have the experience of qualifying your trade every time. Like, it has to go according to the health of the structure, the health of price. You know, there are a lot of things to it, but it's not as difficult as you think.
So I think that the concepts that you can see are are similar. Even if you trade in quarters, which is basically numbers, the concepts are the same. You sell it from the high, you buy it from the low. You look for your liquidity sweeps, and then you hop in the trade. You don't get in the trade if you don't have a liquidity sweep. that will keep you out of harm's way. Kim, are you ready?
Oh, what am I supposed to be doing? Sorry.
Break it
Sorry.
down. Your how you're trading, your zone to zone,
Oh, okay.
how you trade.
Okay. Um, um, so I basically trade from zone to zone. Um, this is on a 2 week because I was doing a 2 week analysis, the weekly analysis.
You might want to stay away from that, Kim. That's not your forte, girl.
Josh, I was doing the weekly and
I'm
two
joking.
week. I was doing the weekly and 2 week analysis.
Yeah.
You're right. I do not. This is not my forte right here, but I know how to do it if I need to know what I'm doing. Um, so basically, what I do is, and I do it from the daily because I'm not a swing trader. Um, so you can, depending on your trading style, you can do it from the 2 week, you can do it from the monthly, you can do it from the 2 month, whatever your trading style is. But I technically really just do it from the daily, and I look for key levels, which are strong levels for me, very strong levels of support and resistance. And I will mark up, I generally just try to mark up um, from where price is, right? And basically what I do is from that particular zone, and I just draw up the zone. It doesn't have to be a perfect zone. It doesn't have to be, um, it doesn't have to be, if I do draw it, it's from the body to the wick, right? Normally I just draw it because on the daily, once I go down to the 1 hour, the 4 hour, it would be this big, massive zone. So I just draw a zone so that when price gets to that area, I know that I am in a very strong level of support and resistance, right? And then once price gets to that area, what I do is look at market structure. That is how I trade. I'm a market structure price action trader. So for instance, from this here, AUD chef, and I'm looking at market structure, I can see right here that this was the last daily swing, and then price has come and broken structure, broke that level, right? So now I'm looking for price to pull back into my zone. And however big or small your zone is, it doesn't matter because you're still identifying structure or market structure over anything. So once price breaks, I know that I'm looking for a pullback, whether it's to this zone or whether it's back up into this area here, which, let's see, let's take this up. Where there's a little imbalance there, there's some imbalance there. It can pull back into this imbalance. And if I see any types of, and what I would do here is actually just put an alert here. And then once the alert goes off, if I see any types of breaks of structure to the downside, that's when I would get in at this zone to take it to the next zone. So I would go from this zone. So once this price pull back, if I saw any break of structure, I would set my entry at the zone and then take it to the next zone. Just that simple. Okay, I know, I say just that simple. It is simple once you understand it and know it. But that's how I trade, zone to zone. But again, I wait for the break of structure on its own, because again, price could come up a little further, either into this order block or somewhere up here to then sell down. Yes, does somebody have a question?
I have a question, Kim.
Oh, Lord.
Why,
Yes, sir.
why is my zones always wrong, but yours?
Because you be drawing zones in the middle, like you're in the middle, your zones be up in here somewhere. I don't know where your zones be
Tim,
coming
that's
from.
what I was gonna ask. Cause Todd mocked up EU, you know what I'm saying? And it's good to get both of you guys' perspective and to see how you mark
Mhm.
up the same exact pair. Like he marked it up, what his thought process was. Do you mind doing it from the daily on EU?
Sure, sure,
Thank
sure,
you.
sure. So I like to look for, like, I need for the zone to be clear. If I have to like squint and say, okay, you can see this is like a zone here,
But that's what
but
I would have said, but you would have told
no,
me,
no,
add
no,
that
no,
in as
no, no,
well.
no. I like for it to be I like for it to be clear. Like it's got to be clear as day to me. Like if I got to squint my eyes to figure it out, I don't even look at it. So for EU, for
Oh,
EU,
yeah.
so for EU, so my first zone would go here because that's just clear to me, right? That's clear that this is a clear level of support right here,
Okay.
right? So now and because I'm doing key levels, but I'm also doing market structure, right? And for me, this is the last major daily swing because price broke this right here. So now I'm just looking for price, and what I'll do is instead of making this I'm just gonna put this as a area of demand. Demand zone. Okay. So when price came here, you were either gonna buy or sell, right? When price came to this zone, you didn't know whether you were gonna buy or sell. And I'm just gonna take this out. Okay.
So is that a key level or that's just a demand zone?
It's a key level.
Okay.
It's a key level. Because it is a zone where price reacts aggressively. That's pretty much what the key levels mean to me. Price came here, acted aggressively, pulled back, acted aggressively. Like even this is a key level. It came here, pushed back down aggressively, right?
Well, I would agree with that. I would just like if I marked those zones, you'd be like, that's not a key zone. I'm like, to me, it looks like the price is reacting from those levels. Now, maybe there are keys on a smaller time frame. I don't know. I don't know
Yeah.
how you, but
And there no, and honestly, like this would be a key level, right?
right.
Yeah, I change it. So price came here, acted aggressively, right? And then it came and then it was support and then it became resistance. I get that. But to alleviate a ton of lines and zones and like I just want to, and that's a clear one right here. This is clear right here for me because it came here, acted as support, then came here, acted as resistance, support, almost support, and becoming support, right?
Yeah, I would agree with that. I don't have a problem with those two zones at all. What's the pip count between those zones?
So from here to here is 100 and
Oh, yeah.
30.
Yeah, it's-
So yeah. So, but when price comes here, because I understand that some people are not clear with market structure, right? So if price was here and then you saw that price is breaking this high and breaking this high, and your assumption is price is going to start buying, right? So when price came back and not breaking, well, I would be looking for a candle close. Of course, I'm looking at it on the 1 hour. So, but when price came back and gave you this candle here,
Mhm.
you still have to see what the next day, we're on a daily, so the next daily candle is going to do. The next daily candle broke through. And I
think
watched it. I do the same thing on the 1 hour. I watch to see what the 1 hour candle is going to do.
so. I think that's the major difference because for me, I'm biased for it to sell based on the higher time frame. Like if you look at the move down, the last
This
swing
one,
down,
this
that
right here.
yes, and
Mhm.
that pullback is going to be to your at least 50%. That's at least a 50% pullback. So I'm
Mhm.
expecting price to continue selling. I'm biased. This is what I mean. I'm biased for the sale. So,
Mhm. Okay.
so
I
that's
can
what
see
I'm
that.
looking for. I'm looking for it to sell. I'm not looking for it to turn around.
Okay, but
Like
let me say this, because I'm just speaking from my experience,
uh-huh.
or from what I see some people are doing, because they're not looking at the bigger picture. Okay, so because people are not looking at the bigger picture, they're expecting this to come here, and because it's breaking structure, they're looking for it to go back up here. I get what you're saying. I understand. I would be looking for the sale. You know me. Once my mind is switched to sales, once this broke and my brain has switched over to sales, and then price pulled back here and then started breaking again, my
Right.
brain is looking for sales. So I'm not
And
looking for buys.
I
Um,
agree. And more importantly, that the bigger swing down, the one in the middle, the one that I
this
highlight.
one here.
Yeah, well, yeah, that bigger swing down is for me was the key to the entire move. Like that swing down told me it was going to sell. It then you got,
Absolutely.
of course, it's a complex pullback, guys. It doesn't just go straight back up to the 78. But that pullback is a very good pullback that you could target your
The
next.
78.
Yeah, that you could target your next area, which would be the negative 27 at least. There's an imbalance down there. You can see it. So my expectation at this point, once we get that 78% pullback, is to sell it to that imbalance. To me, that's where price is going. Regardless of the scenic route that it takes to get there, if you get in at that 78, you have a trade and you hold it until it goes to where it's going. Now, this is where that hedging would have took place. If you had got into 78 and sold it and it went down and it pulled back, you could have bought that pullback. Now, everybody is not gifted enough to buy that pullback. Like they don't see the market like that yet, which is fine. That's why you can trade zone to zone and there are other techniques. But I'm just saying, in my mind, the way I see it, that initial push down tells me, hey, this market is selling. It broke that key level. Now it pulled back 78. It gives you your entry to sell. From that point, you're bearish until it hits your target. For me, and I think that's the major difference. That's why when I come to the market at the end of a week or going into a week, I have a bias. I want to see this pair do this, and if it violates my bias, I don't trade it because in my mind, I already have it trading a certain way. And once it doesn't do that, then I'm not trading it because it's doing something off script. And at that point, in my opinion, it's gambling for me. So I don't trade it. There are plenty of other trades that week that are going to do exactly what that setup says it's going to do. So I would rather trade that than to trade something doing something totally different. Hopefully everybody understands that. I don't want to steal your thunder, Kim. I'm just giving my little 2 cents.
No, this is good because the fact that you guys are doing it on the same pair and it's two different ways of looking at it, it's really good because it lets open people's mind to see it, you know, in different ways, seeing the same pair and how you're both are thinking through the pair. Because we may see certain instances of what you're saying, Todd, certain instances of what Kim is saying. So this is really good. So yeah.
So yes, so definitely once this, based on market structure, right? Price was bullish. And then price broke this internal low, broke this external low, and then broke this low. And so now the shift for me, same as Todd, has been made, right? Because even when I say, you know, I always say, well, you know, Todd would have been like, "Oh, here's the breakage. Here's a change of character."
I would have started. I could have started.
Okay.
Right. Well, I mean, y'all laugh, but that's exactly right because on a lower time frame,
On a lower time frame, yes,
to
that
start
probably
selling
would be.
down.
So,
Now, I'm
and
not going to say I would have known to sell it all the way down, but
I'm going to go to the 1 hour because that's where I sit. That's where I sit. So, if I'm looking at market structure,
you definitely got a break right there too, Kim. And
so this was here and there was a break here. So now my break bias would have been here.
and you can see it gave it to you and pull it right back up and let you in the trade.
So it broke right and then pull back. And of course, I don't enter from the 1 hour. I enter from either the 30-minute or the 15-minute, right? So what I look for is the institutional candle. So everything up here has been cleared. Like this candle, this institutional candle, which means for me, the last up candle before the down move. Now, if I was on a 30-minute, of course, this would have been my last swing. This would have been the break. So this would have been my institutional candle. So my institutional candle, I would have marked, you could mark up the last up candle before the down move. So, and you could have put your entry. I would go back down to the 15, but I don't feel like keep moving this screen over and over and over. And then you put, if I can get a 20 pip stop loss in here, there you go. So for any pair, 20 pips is max for me, right? 20 pips is max for me. So
that institutional candle or order block.
or order block.
I say order block.
Yeah, it's an order block. It's an order block.
Yeah, I know, but I'm just trying to tie it together because I know we've used so many terms. I know Joseph, for instance, asked me about order blocks, but
yes,
this is an example of how you can use that order block, right? And the same thing for me, the same setup that she's talking about. I could have done the same thing with that. I said a displacement candle. In that red candle, there's an imbalance. We don't have to drop down any time frames, but on the one that we originally dropped down here for, if Kim blows this, like makes the screen larger, you can see the imbalance. It's not in your blue box. It's the next drop.
the next drop. Hold on, let me
after your blue box, the next drop. Go over to the right of that.
right.
Oh, I'm sorry, to the right. Keep going. That institutional candle, and you'll see the in that displacement, and then when the market pushes back up over there, it gives you your entry. You're in the ride down. That's the same exact thing that I use, right? It's the same concept. It's the same scenario. You get the same entry. If you were to use the one that Kim had her box around, right? You
Mhm.
would have been in that one too, maybe a little bit lower. But if you drop down to the 15-minute, I know it would have had an imbalance in that kind of the same area she's talking about. But
Somewhere
even
in
if you didn't, huh?
I say somewhere in this wick,
Yeah,
somewhere.
or in the body of that red canal. I don't know exactly where it is, but I know it's in there because I can see the structure.
Mhm.
But either way, you get the same entries, guys. Like it's you're not missing any trade opportunities. We do it differently, and we use different terminology. But if you stick to whichever way you learn it, you're going to find success. It's you're catching the same trades, uh, maybe different techniques to catch the trade, but if you're true to the rules and what validates and invalidates a trade setup, then you will win, right? You will win that trade. And that's the name of the game. The name of the game is win your trade, right? And stay out of trades that aren't good setups.
Exactly. What Ty said.
And the zones are so straightforward. Like for me, like I said, when I take my trades, I'm not in no drawdown. When you take the right trade, you should be in profit. Now, I don't use stop losses. I use price. So if I go negative 250, then I close the trade. I track them, right? So not everybody has the time to do all that, but you're supposed to be entering in the right position in a pullback. Once the pullback is done, it's done. So is it a sweep or is it a pullback? You got to determine that through experience. Everybody's saying their experience levels, and when you hear the right people, you can tell they're privy, right? You can only do this one way. Really, you have to enter at the right location because you shouldn't be in drawdown. We'll keep repeating that, but you don't have the experience with it yet. Once you start graduating through there and start seeing that it actually works, you know that there's no other way to do it. We're doing different ways of thinking, but it's still everything works the same. We should be entering at the same spot, at the same zone with the 20 pip stop loss. It shouldn't hit the stop loss. If it does, it's wrong. It's just straight up, straightforward. And then you got people here in the group that are catching these trades. Ask them questions, right? Get yourself comfortable and confident. Surround yourself with people who are comfortable and confident. There's no reason for you to lose, really. If you're using Kim might hit her stop loss and you might not. But Kim's not going to let the trade get away from her. She's going to catch that trade, even if it hits the stop loss, because right after that stop loss, it's going to give her what she wants to see, and then she hops back in the trade. I'm sure that that's how it works. She's not going to let it get away.
So just FYI for let me just put this back up here. What did I say? 20. Because I heard somebody ask about the hedge. And I know it does take some getting used to. I don't set stop loss. I set a hedge, right? So if my stop loss for this is at 1.127456, then I am going to set my buy stop at 141746. And y'all, you get it. I don't have to change it. So I set a buy stop. So I only trade the edges. I do not hedge in the middle. Like I would not hedge this one here because it's in the middle. If I did not get this trade. If I did not get this trade right here, then when I come here, and you can hedge here. No, let me just say that. Let me say this. So, but based on market structure, I'm only hedging from the hedge. I mean, I'm only hedging from structure, based on structure. And what I mean by that is based on structure, we had a break here. So once we had this break, that made this the swing high. So I'm only hedging from the swing highs. Okay. So if I did not get this entry, so this second entry would be this second entry would be, so we'll put it up there. Okay. So if I am analyzing my chart the way I think it's going to move, if I'm biased for the sales, price should not go past this high, right? So that's the only place I'm going to hedge from. I'm not going to hedge from the middle. I'm not going to hedge. So this was the last swing right here, right? So where's my swing high? My swing high is here. I'm sorry. This was the break. This pushed down and pulled back. So it should not break this high. So you can hedge from your swing high. Now that this broke, this is my high. So if I'm expecting price to pull back somewhere up in here, then it should not break this high. So if you're going to anticipate, we're just anticipating, we don't know, wait for price. If I'm saying price is going to pull back here, that means price should not break this high. So then I can hedge from this high here. Okay. So if price pulls back, and price never pulled back, because price never pulled back and gave another swing high, you can, it's probably best to delete both of those entries. It's probably best to delete this one too. Delete your hedges so they don't come back to haunt you, okay? Because what we know is as price is going down, even when if it pulls back, it's going to start picking up those hedges. But if you're trading from zone to zone, you're out of the zone or the trade based on market structure, right? So I wouldn't, if I'm watching the chart, if I'm not watching the chart, I'm just setting my TP, right? If I'm watching the chart, I'm watching basic market structure. So once price breaks this structure, you can get out of your trade right here. So if you're getting out of your trade here, that's 167 pips. That is 195 pips, because now Bryce has broken structure and is likely going in this direction, but we're still biased for the sell because of the bigger move, right? So I personally don't trade the trend, the pullback. I would be waiting for price to pull back and then sell, because price never pulled back to these zones right here. So that's where I would be looking for price to come back to. These were relatively equal highs right here, and price came and swept those highs and then sold. So that's how I approach and look at the market. So if I I need to see where I am in this whole picture. Right. Okay. So now, if I'm looking at, if you're going to trade from 30-minute zone, here's your key level here, right? This is a key level, little minor key level here. So if you missed this move, this down move, price pulled back, price broke structure and pulled back. right? If you consider this the break of structure, then you know that price broke that structure, tapped into an order block, pulled back to that zone, and then started selling down. So you would take it to your next zone. But as you see, I mean, I can't. It tapped into here and went straight zone to zone. But the next zone is now from here to here. Like I'm adamant about the zones. If it's not in my zone, I don't like to mess with it. I need price to come to my zone. And the fact that price pushed up here and then broke down here, the pullback would be the entry for me to then sell to the next zone. Like I heard Todd say something earlier about like and some people will tell you, some of the group will tell you I'm anal about my zones. Like I don't play. If it's not from the zone, I don't want to deal with it. So and from zone to zone is 205 pips. So I think that's pretty much from this zone to this little zone was 205 pips. The move was really from here to here. The daily zone, from this daily zone to this daily zone, was definitely more than that. So it all depends on what time frame you're marking up your zones from. So that was 500 pips. Sorry. This was a little 30-minute zone right here. So any questions? Any questions?
Thank you, Kim.
You're welcome.
It's
And
such a
then
beautiful thing.
Wick was the order
Stats.
block, was the tap into the daily order block to then start selling all the way down to here. So, yeah.
It's great to stay out of the noisiness. Like this stuff is so straightforward. These moves are pristine. You got to have the zone. Like, why get caught in the mix?
And I think that if you don't have a style, it's a recipe for disaster, because the style or you know your blueprint for trading needs to be set in stone. You need to have a blueprint, and either that trade setup lines up with your blueprint or it doesn't. And if you can just be anal about that trade lining up with your blueprint, you're going to win a lot of trades. Now, hear me out. I'm not saying you're going to be in a lot of trades, but you're going to win a lot of trades. You can be very choosy and very picky about your trades. Treat the trades like you would treat your date, or treat the trades like you would treat your church's bank account. I'm not going to say your bank account because some of y'all spend everything anyway. But you know, be a technician. You know, be very particular about what trade setups that you take. And it's not about losing trades, because we are going to lose trades, but it's about putting yourself into high probability trade setups that are going to work out, you know, and if they're not going to work out, let your trade hit your stop loss and, you know, wait for your next setup. But if you don't come to the market with a plan, it's hard to expect. It's hard for me to understand your expectation to be successful, because you can't expect to succeed with zero plan. You know, that's why whenever we have these live sessions, I want you to come to the call with your chart marked up, because you should be coming with the expectation of, I need to see this and this happen, and then I'll take the trade to here. Like, those should be clear expectations based on where the trade is, or how it's moved that week. You figure, if I'm doing a live session on Thursday or Friday, depending on what the market is giving, we're already deep into the move. The move starts happening either Tuesday or Wednesday, generally speaking. So you need to have an understanding of where the market is, what your pair is doing, what it has already done, and what you expect to see accomplished. Does everybody everybody understand what I mean by that? If I'm losing you, say something, because it's hard to win with no plan.
And we can't force you to do it. As much as we want you to do it, we can't force you to do it. You got to want to do that. You have to be intentional. You just have to be. Now, by this time next year, right, you don't want to be in this position next year. You want to be in the position of, okay, I know what I was doing last year. Now it's time to graduate to the next level. You just have to, or you're going to plateau. You can't plateau in this game. The market's constantly moving. So you got to get into the wave, be on the right wave of it.
All right, does everybody know what pair they're trading in the coming week? Drop a 2 in the chat if you don't know what pair you're trading.